The Q1 earnings results have been rolling in. Looks like a strong start to the Q1 earnings season. Delta Airlines had reported prior to the official season kickoff. Our research director, Shiraz Mian, is here with me now to look at how things are going in the early going. Shiraz, Delta beat expectations, but did their results and forecast offer a look at how well these airline companies are holding up under the surging oil and fuel prices due to the war in Iran?
That's an interesting question, Terry. The thing with Delta is that is the best representative of the group. So even in the fuel costs and all that, uh, this is the only airline that owns its own refinery, and it has an above average exposure to the corporate client base. Uh, so there's a ton of these questions lurking in the air that have a bearing on the airline space as a whole and on the economy as a whole. But there is, you could see it in the Delta results as well. There is uh, this clear positive about the demand for air travel, both on the casual household side, also on the corporate side, and the market's ability to absorb price increases from these players. So I actually, to the extent that one could resolve these macro questions to the satisfaction of the market, I'm actually quite optimistic and see the Delta report uh, as providing a somewhat positive read through on the airline space as a whole.
All right. Well, the banks have also taken the spotlight already, but analysts say that they're on a less certain ground than they were when they began the year. Is that what you're seeing?
I think that's a fair statement, and it goes back to these macro questions that I was noting, and you referenced as well, the high fuel costs and associated uncertainty. The banks, we have to keep in mind, Terry, are a very domestic and very cyclical business. So if you raise any questions about the health of the economy, about the staying power of whatever growth outlook you had factored in at the beginning of the period, then that'll have a bearing on the outlook for banks. And one of the things that all of us have been really looking forward to for these big banks and the investment banks as to how the deal pipelines, the M&As, the capital markets activities, uh, for a number of quarters have been talked up as something within reach and something that'll start showing up. And we were expecting quite reasonably, I should add, that those expectations will start bearing fruit. If not in Q1, then definitely in Q2 and beyond. So again, those activity levels, investment banking, capital markets, uh, they require a stable uh, macroeconomic backdrop, and those deals get pushed out when you have uncertainty. So, to that extent, it's a bit of a problematic outlook. Now, on the positive side, there is a lot positive going on, and we saw that in the results as well.
So their earnings still look solid?
Very solid. They uh, and some of these big guys, the JPMorgans and the Wells Fargo's of the world, the stocks were down in response to the results. I would say some of it was the stocks have done reasonably well uh, over the past, and it's just catching up to them. These companies are inherently very conservative as well. So, like the net interest income outlooks from JPMorgan and Wells was relatively on the lighter side. But if you look at the demand for loan, it was very strong. In fact, the strongest that we have seen in the post-COVID period. And the credit quality, the reserves additions, that remains rock solid. So if we are able to have a relatively favorable resolution to the macro questions, which appears to be the case, going by headlines, Terry, then I think we go back to the more optimistic business outlook for these banks.
All right, let's recap the scorecard.
So, including all the results that came out this morning, we now have results from 48 S&P 500 companies, almost 10% of the index membership. Earnings for these 48 are up 29.3%. Revenues are up 12.4%. 79.2% are beating EPS estimates, and an equal proportion are beating revenue estimates. This is a notably better run rate, both the growth pace as well as the beat percentages for this group of companies.
How does the beats stack up against the misses?
So more beats than misses. I would say the revenue beats in particular, though it's admittedly a bit on the early side, Terry. The revenue beats are off the charts. I would say for this group of 48 companies, the 79.2% is the highest that I've seen over the last 5 years.
Okay, margin picture so far, what does that look like?
Holding up, pretty stable, modest improvement as was expected, and I think that's a fair expectation that will most likely carry through to the end of the Q1 earnings season. So good developments, positive developments on the margins front as well.
Estimates were soaring going into this Q1 season, but the S&P 500 index overall continued to see declines until just recently when it fought its way back. Did that have anything to do with the earnings concerns?
I would say so. So the short answer to that is no. It was not earnings concerns. It was primarily these geopolitical tensions and worries about what that would do to the what the Fed will do to the inflation outlook. I would say had the earnings outlook not been this good and this strong, we would have had a lot more weakness. In fact, I keep saying this, that the positive earnings outlook is one of the best supports that this market has. So the earnings picture continues to be extremely strong.
You know, analysts seem to me, anyway, to be more optimistic than usual in their Q1 outlook. Is that how you're seeing it?
Absolutely. I think after a very long time, Terry, we are seeing not only the reported and the actual results being very strong, but also the outlook for the coming period. So, and even more significantly, it's not concentrated in a finite area. Like tech has been one area that has been positive and strong for some time now. But we are starting to see the positivity expand beyond tech. And one of the things that I keep pointing out is that for 2026 as a whole, this is for the first time in a very long time that even prior to the Middle East conflict, we had 15 of the 16 ZAC sectors on track to report positive earnings growth. And what the conflict did was it pushed the earnings outlook for that remaining 16 sector, which was the energy sector, also in the positive territory. So we have, for the first time in a very long time, all 16 sectors on track to achieve positive earnings growth this year. So a very favorable and positive earnings backdrop for the market as a whole.
So if you had to put a number on it at this point, what are the Q1 earnings on pace to report growth-wise?
So the expectation at current is that if you combine the actuals for the 48 with estimates for the bulk of the still to come results, it's a little north of 14%. But given how these results have panned out thus far, I wouldn't be surprised if the actual final read for Q1 is the best earnings growth we have seen in the post-COVID period. I would say it's 14% now. I think it could be higher than the 15.8% we saw in the third quarter in 2025. It could be 16, 17, 18%. So the highest growth rate, most likely this quarter, ever since the current growth cycle got underway in 2023.
All right, that's what the Q1 earnings season picture looks like here in the early going. Don't forget, our listeners can always keep up on Shiraz's written commentaries simply by going to Zacks.com's homepage and finding it right there. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.